for a first. We need to talk about something that's a lot bigger that's going on in this world, and we all have our opinions, we all have our analysis, and today I'm going to just share mine, if that's okay. So the topic for today is doom boom, doom boom, doom and gloom. All right. So if you are interested in trading at all, we do have a site, a website, a Facebook group, so you can join. All right, it's free obviously, and there's a lot of things that's probably related to investors as well. For example, why I'm scrapping this gold stock. Are you interested what the gold stock is? No? Yes?
Yes. Yes.
There we go. I need more engagement. Okay, it's Harmony. It's become a small cap and it's kicked off my portfolio. So let's get straight into it. And we're going to talk about the next 41.9% stock market crash. All right? But we have to first take you back on a journey. We're going to go back in time. All right? Let's go to the year 2000. And you all know where I'm going with this. Say again? The dot-com bubble, which started not only in 2000, but in 1997 when they actually bought those internet stocks beyond the valuation of the actual shares, right? So if we go to the facts, 1995, there were 44 million users on the internet. I think I was one of them, I can't remember. Do you remember the dial-up connection? Anyone remember that? Those were the days. Actually quite an experience. Today there's 2.9 billion people and counting. Mark Zuckerberg at the moment is trying to learn Chinese to attract another billion people onto Facebook, which is phenomenal. 1999, 457 IPOs, initial public offerings, were listed. Most of them were internet-based and technology-based. And that was mainly on the NASDAQ. Today the NASDAQ has over 3,000 shares, right? 117 doubled in price on the first day. So what is causing that price to double? Is it people that have actually gone through the analysis of the companies themselves? Yes or no?
No.
No! We doubled the share price in a day in 117 companies. What was it? One word. Greed. Greed. They said that every single stock that we get into in 1999 is going to be the next Microsoft. Because what's going on? There was the era of information. Era of information kicked in. The internet was a huge success. It still is, absolutely. But the problem is, with the greed and the emotions, they drove those prices up beyond the fundamentals. So they ignored the PE ratios. They ignored the earnings yield. They ignored the market trends and the fair company valuations. And this is what made the prices just keep going up, right? Because they thought that it was going to be the size of Microsoft. Is this still on? I probably don't even need the microphone, do I? But anyway, I'll hold it, yeah.
Is that okay?
That's okay, I'm sure.
Can you hear without the mic? No.
No? Okay, I'll just speak louder. I've only got 30 minutes, so I can scream a little bit. But they were horribly wrong. So now I'm going to show you the charts, alright? I love charts. You're never going to see me in a presentation without a chart. Watch this space. So, what are we looking at? We're looking at the FTSE 100, the Financial Times Stock Exchange, which makes up the 100 biggest stocks on the London Stock Exchange, also known as the FTSE. I know this doesn't really apply right now, but I need to show you this so we can go forward as to what happened in the other crisis and what could potentially happen very soon. So the FTSE 100, you can see that from 1997, the stock prices started climbing and climbed at a huge inclination. That degree is over 45 degrees. And I actually have a general rule. And this doesn't only apply with trading, but it also applies with investing. And that is, notice the trend of the stocks. If the stock is less than, say, 30 degrees, it means that there is still a little bit of uncertainty, a little bit of confusion in the market. They don't really know where they want to take the prices. You know what I mean by 30 degrees, right? That the market's going very gradually. It's not a strong trend. A strong trend and a healthy trend is 45 degrees. So 45 degrees, so-called, with little zigzags, little corrections. And this here, you can see, is over 45 degrees from 1997 to the year 2000. And then what happened? Because they overvalued the company's share price, because they didn't take in the fundamentals of the shares, they then started selling all those stocks. And it started causing panic in the markets, especially the FTSE 100. And you can see that there was quite a large crash. So let's see what are the specifics. 31st of Jan 2000, 6,930 was the index level. Then the bottom of it was the FTSE low. 31st of March, it's amazing it was the 31st as well. 2003, 3,321. And that's the dot-com bubble, 52% crash. Let's look at the JSE. Hey, it wasn't that bad. It didn't even look like there was much effect. So the JSE didn't really have a dot-com crash as per se according to the charts. All right. I know there was a company that went bankrupt, that was also overvalued. That you can take a guess. It was Dimension Data. Dimension Data in the year 2000, it was trading at roughly 69 Rand 60 cents. It then crashed. And by the year 2003, it was at 1 Rand 98. 1 Rand 98. So that didn't seem good for the development of the internet and a company like dotcom. So let's see what happened. 2000, it was at 8,558 level. And by the time it was 2003, it dropped to 7,322, which was 14.4% knock. But you can see in between it still made all-time highs. So it wasn't like the FTSE. A little bit more recent, 2007, 2008, we now move on to the financial crisis, which, as you know, was a disaster. Was anyone affected by the financial crisis? Hands up. A lot of people and a lot of companies worldwide. All right. So you can see the high. I'm not going to go into it too much because we have quite a bit to get through. The FTSE high was at 6,930, and then by 2009 it crashed to 3,321. That is a 52% crash. So do you notice that the crashes are more or less same percentage? You get a 40% or 50%. Now let's look at the JSE, more relevant. You can see it pretty much correlates to the FTSE 100. And why? Well, because there's more dual-listed stocks on the FTSE and the JSE compared to the tech stocks. And the FTSE, and I stand to be corrected, leads the other markets. Okay? So when you see the FTSE lining up for a crash, prepare for the JSE to also have a crash, but make sure that you know the fundamental reasons behind it. So 2000 was internet and computer-based, 2007 was property and bank-related, and you can see that the JSE made a 45.18% crash by 2009. But can I tell you something even more interesting? The JSE then made all-time highs. But we'll go into why you don't really have to worry with the crashes that come. So basically I'm going to curb your emotions for when they happen. Don't be too upset or anything because you get affected. But if you're investing in stocks and all that on the JSE, they tend to make all-time highs again. Okay. 2015. What do we have? Anyone? Louder. We had banks collapsing in 2008, and now we are having, for a couple of years now,